Hello, good evening, everybody. Stanley here. Nice of all of you to join me, and I hope you can hear me well today. And today, we are finally back in our bi-monthly, bi-weekly webinar. And today we're going to talk a little bit about Meituan. But how I'm going to go about doing it is I am really going to use Meituan as more of a case study. Of course, I have updated some of the key analysis that I have gone through before when I introduced Meituan as one of our stock of the month. But I'm going to use it this time around as a process flow. So we're going to use it as a key case study and show you my process of how I come about looking at different companies and how I stumble onto Meituan and how I go through step by step on how I analyze the company until the point where we make a decision whether to invest or not to invest. And apart from that, I'll have a little snippet on some of the different research that I've done over the week and just share with you some interesting findings. I hope you enjoy today's webinar. And once again, welcome everybody. I can see that we are getting a little bit more people joining in as we start, but no worries. Anytime you have any questions, you can drop me on the chat box your question, and I'll try to come back to them either at the end of it or as I see where is a good break point. I'll have a break and we can have a little chat about your key questions. It doesn't have to be just about Meituan, right? If you have any other question on your mind today, you can let me know as well. And that's what the key things that I want to bring about having a regular webinar with all of you guys members is so that we have a forum basically that we can have interaction on some of the key things that you are thinking about these few weeks and have a touch point where we can discuss a little bit more, or maybe even if I do not have the answer for you straight away, it's still fine. I'll make sure I remember it, and I'll go and research up on it, and before I give you an answer through our members website as well, right? So without further ado, let's get started, and you guys can let me know if you're ready to get started, and have you had your dinner? Let me know what did you have for dinner, and I'd love to hear more from you later on as we discuss. Okay, so this is something that I added in compared to my past webinar. I realized that I haven't put on a key disclaimer, like as everything that we have gone through before on our website, on our YouTube page. Basically, this information are just for educational purposes, right? Do make sure that you use these resources as a touch point to do your own research and come up with your own investment decision. Okay, and welcome. And this is a Premium Club only webinar. So some of the content point that we go through today is going to be a quick short story before we jump into Meituan of some of the things that I've been thinking about these few weeks, and then later on we'll go through Meituan in the detail in the sequence of how I normally research a stock. Right, this is a typical method that I use. I tend to use over many other stocks as well. And I'll go through step by step with you guys. And then later on, of course, we'll have a spin-off section that I tend to have all the time. And lastly, on the last part where I want to share a little bit with you some of the things that I've been working on, and I'm very excited to explore that with you. All right, so before jumping into Meituan first, this is actually article I read through a few years ago, but it recently come up on my alert again, and I find it quite interesting, and we should be time that we do some refreshment on it, which is on Fidelity, which is one of the key, maybe you can see it as a key brokerage or investment house in the US, and they have done a study before reviewing actually which group of investors actually did best over the long term, right? See, across I think there are millions of clients, and across all their clients, which are the clientele that is having their portfolio outperform and having the best results. And the interesting thing of what they found is that the classes of investors that are doing the best are actually those who are either dead or who has forgotten that they have an account with Fidelity, right? And this is key, which is that in order for them to outperform, I guess not outperform, but having great investment return is mainly because they have kept being invested and not touched their portfolio for a long extended number of years, so that they can let the real power and magic of compounding works. Without that, a typical investor, you can see that this is from another study, but a typical investor of someone that is investing in the stock market by themselves and for the long term, you can see that we as average investor generally doesn't really have that great of a performance. This is a 20-year annualized return. I know the data is a little bit old, but it also symbolizes, the average investors get around 3% return a year over the 20 years period, whereas the S&P 500 is over here at that period of time returned around 9%, 9+% over the long term. And of course, different sector might be doing slightly better, but it's really telling, right? It's really telling, showing us that actually the worst enemy when it comes to investing is actually ourselves, and that's quite a revelation for me when I first stumbled across this database. And I just want to reiterate that with you guys again, which is, it's very, very hard for us to stay invested and not touch our portfolio over the long term, right? In theory, it's very, very simple. And that's actually the strategy that's going to give us the best return possible for typical average investors like ourselves. But the issue is, it is so hard to do it, mainly because the market doesn't fluctuate in a straight line. It's so volatile. Every day there's news, every day there's something new. There's always something to be worried about. And across the duration of 20 years, just think of across the duration of 20 years where technology can be totally obsolete and a new type of interface will come along. But for us to not be as distracted by that and continue to stay invested and stay true to our investment philosophy or strategy is really, really hard. But I think it's still very, very doable. And as long as we understand that and we can control and learn to control our temperament, learn to control our impulses, I think it's very, very doable that we can move from just being an average investor and move all the way up to here, which is 3 times better than an average investor, and just at least being able to track the market in our performance. And this is generally a strategy that I have implemented into myself, and it's a strategy that I find it's continued to bear fruit for me. And as long as the longer I stay invested, the more that I'm seeing the fruit of this strategy that I have created for myself. And I do that mainly by investing in stocks that I believe in over the long term, and plus also just looking at passive and low cost ETF or index funds, which can help me track the market even when I do not know where to invest. And a key part of staying invested is also understanding these 2 graphs, right? This is basically sharing with us over the 15 years period on the S&P 500, right? If we have just stay invested and do nothing over the 15 years, we'll get roughly about, for this database that I have gotten, we get around 8% return every single year. But if just if we miss out only on the 10 best days, 10 best performing days within the entire 15-year period, right? That's more than 3,000 trading days, but just 10 of the best days and we miss out because we might have sold out, or we just trade during that period, our return dropped from 8% all the way down to just 3%. And if we miss out on 30 days of the best 30 days in the 15-year period, that's just 1% of the entire 15 years period. Our return on our portfolio actually turns out to be a negative 2.47%, right, from this database that I've gathered. What this means when we translate it into real money is that if we have $100,000 invested in the S&P and do nothing for 15 years, regardless, and not be enticed by the noises that we hear every single day, at the end of it, 15 years, our portfolio grew to around 300,000. But if we just miss out the 10 best days, our portfolio actually close to half to become just 15,000, 150,000 plus. And if we miss out on all the 30 days, it basically become less than what we invested, to just 68,000. So that's the key difference I want to share with you guys. The problem that once we feel that we can time the market, is going down a very, very slippery slope. And in fact, the best strategy for us, if we don't have a crystal ball, is actually just stay invested in the entire duration of our portfolio, of our investing life. And the second part, which I realized that would have a very, very big impact, right? So the first thing that will have a big impact on our portfolio is actually understanding that the more we trade, regardless of how much conviction that we have, the more we trade, it tends to correlate to more mistake over time, and that will really, really hurt our portfolio in the long run. And the second big part that I realized why my portfolio has been doing generally well is that I try to minimize fees as possible, try to avoid high fee funds, try to avoid fees that require me to have a big sales charge at the front. And so looking at low cost option for alternative that otherwise that things that I can only get through maybe mutual funds, I'll always look for other low fee alternative along the way and invest in those instead. And just to share with you guys how big of a difference it could make is just by looking at this key chart that I've created, right? Say if we have 30 years to invest till retirement or till the day that we want to pass this wealth to our family or our children. Imagine we have a 30-year period of investing from today. And if I find something that is no fee, of course, it's almost impossible to find something that's no fee, but just for the benefit of the doubt, for this example, the base case is investing in something with no fees. If we invested 100,000 at the beginning and doesn't do anything else, right? That no fee portfolio, if it compounds at roughly 8% a year, just 8% a year, over the 30-year period, our 100,000 will become 931,000 in totality, almost $1 million by just investing 100,000 at the beginning, so almost 10 times our money. But once we have invested it through something that has many a management fee of roughly just 1%, just a 1% management fee in some funds that we invested in, that amount will amount to, at the end, only 700,000. This means that 1% fee of 100,000, right? 100,000 when we invested, like when we think, oh, 1%, it's just $1,000 a year. But that compounded over 30 years, we are actually paying 200,000 plus in fees, right? Again, of course, here I'm not saying that it's possible to find something that is totally no fees, right? There's going to be fees, but we definitely have ways to minimize this number to be less than 200,000. And this is just only on looking at a fund that with 1% portfolio management fee, right? And most funds that we look around might have fees even higher than that. maybe a 2%. And if it's a 2% annual fees fund, then that difference can be up to a 400,000 different, right? When we get into retirement, a difference between getting $1 million when we retire or just $500,000 when we retire. And that's how much this small percentage, when we look at it, it's just a 1-2%. It doesn't matter. You know, even if I buy a property, it's gonna cost me a 3% sales charge or something. But all these, I just want to let you understand, right? Over a long time, compounded, it could become a very, very significant amount. And definitely there are ways and strategy for us to minimize that. And the third example I give is maybe a fund that you bought through and which requires some form of sales charge at 3%, but and still has a annual fees of 1%. And how much of a difference, right? And you realize that actually the sales charge is still okay. If they charge it right at the front, and that's all, and that's still okay. There's not too much difference with the annual fee. And in fact, the one that is gonna amount to a big sum of money is actually coming from this annual expense ratio that we talk about in the funds, annual management fees. And this is something that we can definitely look at on finding a much better alternative along the way. So this is something I want to chat a little bit more about at the end, but just hold that in your mind, in your thought, and we're going to come back to that later at the end on how some of my strategy that I think definitely we can look into to create a much better and more efficient portfolio for each of us. Okay, but now let's jump straight into Meituan. And who here know who is this guy? Let me pop up the chat box so I can see where you guys as well. So if you can type on your chat box anytime you want, and let me know if you come across something and you want to make a comment at your own pace. Turn on the chat box and you can chat with me. But so this guy is basically the founder of Meituan, Wang Xing. Okay, and Meituan is actually not that old of a business. It's only created in 2010. So this is basically after the financial crisis, and Meituan was first founded. And let me just go through my notes. Okay, and Meituan basically is actually not his first startup. So Wang Xing was actually someone that is extremely smart, and he can be considered one of the top scholar in China. And then he went to the US for his what do you call it? PhD is postgrad, and he didn't finish it, but because he saw the rise of the internet, and when he was in the US, he saw many of the huge tech giant today that has just starting to get founded. And what he realized that he cannot miss out on this wave of new tech startup boom. So he rushed back to China and he founded many companies before he founded Meituan. So the first one is he copied Friendster, and a social media platform. You realize that he kind of like this model of social media. He's going to do it over again and again. So he started with Douduo, and which is a copy of Friendster. Unfortunately, that didn't work. He tried for I think one year plus. That didn't work, and of course we know that Friendster also didn't work. But then he tried to copy Facebook with his new website called Renren. It's actually previously not called Renren, it's called Xiaonei. And then he built it up. He actually got an exit from it. He was able to sell it, but not for a lot of money, but he was sold it, and then it was rebranded as Renren. Next, then after that experience, he wanted to try again, and he came to copying Twitter for this time around with Fanfo, which is a Twitter-like, is very similar to Twitter, but the problem with social media is, of course, they're going to be very sensitive topic. And in China, once you have very, very sensitive topic being discussed, especially politically sensitive topic, you're going to get censored. And he faced a lot of issue with censorship and with regulation. There's a period where the whole website got banned for a while. He got it back up again, but then he was always stepping on the toes of the regulators and trying to moderate what is being discussed within Fanfo. So at the end, it was also not really a success for him. And then he turned to the next group of app that he want to copy on, and this time is Groupon. He was actually one of the first that had seen Groupon and try to copy that model into China. So if you still remember, Groupon is basically group buying and having a lot of for merchants to sell their vouchers or promote their services on the platform for bulk discount. And he started it with Meituan. But once he started it, it created a boom in this group buying space. And following that, so much money was poured into this space that there were close to around 5,000 competitors that Meituan has. But unlike all these newcomers that is rushing in with hot money, with VC just spreading money across all this, hoping that one would work, Wang Xing by this time is no longer a rookie startup, entrepreneur, but rather he's quite considered someone who is very, very experienced, someone who has already started 1, 2, and 3 social media platform and going on the 4th try. And so, although he's still doing a copycat, they call this C2C strategy, copy to China. They're still doing this strategy, but he's much more experienced. And instead of just burning money like the rest of his competitor, so trying to just gain user and gain engagement, he do it very, very systematically. Make sure that his operation is operating very effectively. And when he raises money, he makes sure that he has buffer to ensure that he can survive. Although it's a tough fight, but across these 5,000 players, Meituan, basically after a few years, emerged as the winner, right? And all the others went bankrupt, I guess. Left 1 or 2. And it really solidified his position when Meituan and the competitor Dianping merged, and it became Meituan Dianping for a while before they changed back the name into Meituan. And that deal was actually brought together by their common shareholder, which is Tencent at the time. So it took Wang Xing, I think, from this era, not that long. I can't remember the number of years, but just 5 or 6 years before he reached Meituan, and then another 5 or 6 years for Meituan to solidify its position as the leader in this space. And once that happened, he's able to spread the services of Meituan to other areas like food delivery, to shopping and Insta shopping, to grocery and everything, and even to hotel and travel. And this is basically the key business of Meituan today. The core business of Meituan, when they break it down, it comes to these 4 areas. And so this is the part where I would read through their annual report and then break down to try to understand what is the real business of Meituan. Okay, so let's going back to our key process on how I think about what are stocks to invest in. Meituan came to my scope mainly from what we call a top-down approach, right? In investing, there's 2 types of approach where allows you to find for possible candidates to invest, the bottom up and top down, right? So bottom up is basically scanning through the financials of the companies, finding which are the companies that meet your financial requirements, say having good ROI, having no debt, having good growth, right? And then you screen through and find these are the companies, regardless of which industry they're in. Another one is called top down, which is looking at what are the industry that's interesting and worth investing in. And this is how I come about with Meituan first, right? I was just looking at interesting Chinese tech companies, and a big part of it is what we call O2O, so online to offline, right? Which are the tech company? Because at that time, e-commerce is basically is already quite established, with Alibaba and JD all quite established at the time, and online social media with Tencent and gaming with Tencent is also quite matured. So at the time, I was just looking at maybe the next interesting thing would be linking online and offline world, and this is the landscape that I'm trying to look for, and of course, the main company within that space is Meituan, and that's how you can see the top-down approach of looking at interesting sector that you want to invest in first, and then looking at who are the key players within that sector and understanding that. And once I select, okay, let's look at Meituan, then our first thing I dig is really to understand the history of the company. So looking at its founder, and then looking at its progression. What we are trying to establish here is to understand the founder characteristic, to make sure that this is a guy that has the motivation, and also has the capability to really lead a company for the long term and be a great founder. Because in tech space, a lot of times you need a strong founder because the future is so unknown, and you need someone who is decisive and able to motivate the team to move forward and break new grounds. So by learning their history, you sort of understand the characteristic of the founder. And then after that, I'll read through their annual report, I'll read through what their investor relationship site will provide me with, to just understand what is the key business of Meituan. And basically today, the key business of Meituan comes down to two key areas, which is food delivery and hotels and travel, and also shopping. So they earn money through three key format: either online marketing, which is the merchants has to buy advertising space within their app to promote and get more people to buy from them. Next one is just having a delivery fee every time you order a food takeaway with Meituan riders to take the food to you. There's a fee that is charged to Meituan, and of course another portion to the riders as well. And then lastly is also commission based, where if you are even ordering food from the restaurant, they will get a cut from the receipt of what you order. Similarly, if you are using Meituan for buying things or even grocery shopping, these are the things that they are going to earn some money on. And others is basically their new initiative. So they break it down into new and core. And these are initiatives that basically they are experimenting with, but it's still not profitable, right? So the online marketing on core business, on delivery, on commission basis, is actually already a profitable business. But you can see that the margin of Meituan today is still quite weak, mainly because they are still plowing a lot of money into new initiative. They're trying to break into new markets and finding areas or new areas of growth. And the key part for this one is actually grocery and linking directly with farmers. So they can allow farmers to list their products directly on Meituan, or for supermarket can list their product, and then you can buy your grocery or buy your produce directly from the app. All these, they're still building up the infrastructure, and also they are fighting against Pinduoduo mostly and TikTok on this area. So it is still a sector where there's no one key established player, and which is why it's still burning a lot of money for them. So, like I was explaining before, so once I understand from the annual report and I read through, I try to formulate and structure out what exactly is their business, where are the key points where they can earn money, where are the key points of growth potential, and trying to figure out the entire business. And this is basically a rough summary of Meituan. So they can earn fees from delivery, not just from restaurant, right? You're buying your medical stuff from pharmacies, from shopping, right? You can actually buy, say, the new iPhone from Meituan, and someone will go and collect it for you and deliver it to you. And they're working on the possibility of delivery in 30 minutes, even for shopping, right? So today, if you say from Meituan, I want to buy the new iPhone from the Apple store, you can click the order, and then the delivery man will go to the nearby shop, Apple shop, and pick it up for you and deliver your new iPhone to you within 30 minutes. From that, they have a commission base of either 12% to 20% up, but this delivery fee is actually coming down a little bit, mainly from higher costs that they need to pay out to riders, because the regulators is starting to force them to improve the compensation for riders, right? Adding, say, insurance for them, or more benefit for them. So a big part of the cost will eat back their revenue at the moment here. Another part is just commission on online booking. Say you book your hotel rooms or your travel packages, you can buy it from Meituan, and they're basically a marketplace, and they earn a commission from there. And of course, the most profitable part for them is online marketing, where merchants have to fight for spaces, marketing spaces on their app to attract the large user base that they have. And then lastly, the others is Meituan Select, which is their group buying part of the business, very similar to Pinduoduo, and also their Xiaoxiang supermarket, which is grocery shopping. And so you can look, I break it down for you guys. You can see that they actually has pretty decent operating profit margin from their core business, right? The established one, their hotels, their food delivery, and shopping, your core shopping. They already have established a operating margin of around 18.7%. But all the new business that they're pouring into the grocery and Meituan Select, which is still loss-making, is actually losing a negative 28.9%, the operating margin. So red color means negative. So it's actually having a negative 29% operating margin for them. And so in totality, their operating margin is now at just 4.8%. But you can see that a big part of it is because of all these new initiatives. They're trying to burn a lot of money to try and gain market share on the new sector. And when we look at Meituan as a whole, what is the addressable market? For now, at least, I would say that it's still mainly Chinese domestic demand. But I think there's still a big part for them to grow, both in terms of food delivery, but also domestic travel and even shopping, right? If they can extend the delivery from they can extend the delivery services to not just F&B and food, but just doing your shopping for shopping as well. There's a wide, big market for them. And I'm sure it is nowhere near saturation. Even though, according to Meituan, they are doing around 40 million deliveries every single day on average. 40 million delivery every single day. But according to them, they're optimistic that they can reach the target of meeting 100 million deliveries in the next few years. So that's 2.5 times from where they are at the moment. And so, the pie is still growing very, very fast. Later, I'll show you their revenue numbers and profit numbers, and you can see that they are actually still, until today, growing extremely, extremely fast. Outside, meaning that outside of China, there's also some potential. But for now, they're not going to do it directly, but rather they do have some outside investment where to companies that is doing similar model to them. For example, they actually invested in Gojek, the Grab of Indonesia. And after Gojek combined, I think now they're called Go2 or something. They're still one of the shareholders of the new company, and so they do it through investment, similar to how Tencent was doing it at that time. Next one is Meituan Select. It is struggling, which I have touched on a little bit. So this is an area of concern for me. So when I list down and break down their business model, understanding which are the part that's making money, which are the part not making money, and then we try to understand how big is this market for them? Are there still room to grow? And we concluded that yes, there's still room to grow. And then trying to understand where are the key risk points. Things like Meituan's Select, their new initiative, and these are the things that we should take note of. These are the risks that we have to think if we are willing to take, right? After that, after understanding all that or thinking through all that, I like to just confirm my understanding with the financials. And the numbers of a company, I believe, tells a story. And by just looking, you can read through the annual report and see how optimistic they are talking about. But if that story doesn't translate to the numbers, then it means something is not quite right, right? Maybe the management was giving such a beautiful story in the annual report, and you're seeing that how optimistic they are. But when you look at the financials, the company is not really growing, stagnant, or maybe even seeing declining revenue. Then there's clearly a mismatch on what the numbers is telling me and what the management is telling me. So what I'm doing here is, after reading what the story of the management is trying to tell me, understanding the business model, I'll look at the numbers to make sure that that story is translated, that numbers is telling me the same story combined. So from here, things we want to look at, of course, there are three basic statements: income, balance sheet, and cash flow. Want to understand, okay, the one thing that I want to know, of course, on that is this company has a reasonable debt and that they can maintain it, when in fact Meituan is actually on a net cash basis, so that's pretty good. Segmental, I'll show in the next slide some of their revenue, which is still growing very, very well. Margins, I like to know if they can reach a point where they can be profitable. They have actually proven that they can be profitable if they don't choose to expand a little bit, right? But of course, they still need to find ways to grow the business as well. So they have to have a balance. And then lastly, look at the cash flow. Right now, cash flow is not very consistent. They do have good cash flow last financial year to 2023, but at the moment it's still not very consistent, and that's something that we want to take note of. Okay, so these are the financials numbers that I translated into Excel, and you can see that revenue is actually growing at 58% a year over the last decade, right? Over the last decade until today. Even if we just look at the last 5 years, even just the last 5 years, they are growing at around 32% a year over the last 5 years. So this is a company, even though they can be considered the leader in this field, is still growing extremely fast. It means that the market is still growing very fast. You can see that the company has been quite losing money for quite a long time, and finally making some money this year. Similarly case for the net income as well. So this is the operating and this is the net income. And they have always, I would say this, the management has always pushed for more and more investment into new fields, which is why they always plow back what they have to grow the market and even to find new markets to continue to grow. This is the operating cash flow. You can see that over the last few years, they actually become positive cash flow, which is something that I guess would give us more comfort that the balance sheet will be relatively okay going forward if they don't do crazy things. Okay, so by understanding the business, understanding what the management have planned, what they have said over the past few years, the understanding the history, together with looking at the numbers and formulating the story to make sure it match. After that, what I tend to do is just either doing it outright, writing it down, or just having a mental note, which is doing a SWOT analysis, just looking at what are the pros and cons of this company, and the simple things like where are the key strengths of the company, where's the weakness, a threat, opportunity. So this is the this is the summary that I have think through, which is their strength of course comes from the economy of scale and the network effect. As more merchants is on it, as more users is on it, everyone will tend to consolidate and this will become the platform of choice for everyone when they are trying to find something that a place where they can get their food instantly, at least within the next hour, or they want to buy something and need to get it instantly as well. Because even with the logistic of JD or Taobao or Pinduoduo today, it's very hard for them to get a product to you within 30 minutes. But Meituan is one that is able to do that, right? With their army of riders. Next one is, oops, sorry, I pressed something wrongly. Next one is, of course, looking at their weakness as well. This is a business that is very capital intensive. They have to maintain and manage all these riders just roaming around the entire China and ensuring that they give enough volume of business for these riders. They need to, it's a very hard business because they need to keep both the customers happy, they have to keep the suppliers happy, the merchants happy, and the riders happy. So they are stuck in the middle and they have to make everybody happy in order to earn their keep. And it's not very easy to do that. And this company is still quite reliant on Tencent, basically WeChat, because a big part of their orders is still coming in from the WeChat mini program. So they are still very reliant on Tencent. But after the spin-off of Tencent, there might not be that big of an incentive for Tencent to support them, to go out of the way to support them. Right? Previously, because Tencent owned a big chunk of Meituan, Tencent can, in fact, be very actively helping Meituan to grow as well. But Tencent has already divested everything, all their Meituan shares to their shareholders. So in theory, there's no link between the two companies anymore. So that will reduce the incentive for Tencent to promote them over other companies that's on their platform as well. And of course, another issue is that I am worried about is the new initiative. They're still burning a lot of money. When you read through what the management is thinking of Meituan Select or their Xiaoxiang supermarket, it doesn't even seem they're very optimistic, right? They're saying that they need to sort of restructure and find the optimum way to do this business. So they're still trying to figure it out. There's something of a little bit of a turn off, I would say. Threat, of course, in China, always government regulation, competition. As they expanded to new markets, they are going against very, very, very tough competitors now. And there's threat maybe of unionization either on the merchants level or the riders level. Those could also affect their pricing power with these counterparties. And riders is something that the government is on the side of. So the government is also pushing them to give rider better compensation, better care, better insurance. And all this will add up costs to them over the longer term. Opportunity, of course, we talk about. There's still a lot of growth, not just from domestic consumption, even moving to other space that they are looking at, medical space, maybe even the financial services, and of course tourism within China. And maybe even opening up Meituan for foreign tourists as well. Because the last few months that I went to China, it's not that easy for foreigners to sign up to Meituan because you will need a local numbers to register for the account, right? And it, of course, I can get a prepaid and register for the account, but it adds a layer of difficulty for just a foreign tourist that might also want to enjoy the benefits that Meituan provides when they're just around sightseeing or booking for tours or booking for hotels. That is not very inviting, I would say, that Meituan for foreign tourists. So if they are able to tweak that and maybe have a international version for it, it's not much compared to the domestic market, but I think it will also be a possible growth area for them, especially when foreign tourists, I would say the spending power and spending, the willingness to spend will be much more since you're already traveling there for holiday. You know, if they have an international version, even with higher commissions or higher prices, I think some international travelers would still be more than happy to pay for it. That's my thought. And of course, this is the chart that I wanted to share with you guys. Their reliance on Tencent. You can see that a big part of their orders is coming from WeChat mini program here, here, here. So Meituan select the grocery one. Almost all of it is coming from WeChat mini program rather than directly from their app. It means that they are at the mercy of WeChat on this one. So this is a typical flow that I tend to use when looking through a company, and from there, I want to decide whether this company has a moat, and I tend to only want to invest in company with some form of moat. Of course, moat something that Buffett talk about quite a bit. So it's just something of a protective layer that the company have to fight off competition in the long run. And it can come in the form of economy of scale, branding, network effect, having special IP, maybe too high of a startup cost that nobody would want to go against them, having some control of resources or just switching costs, where they can capture the customers and customers would not really want to change. And this is of course just a subjective rating, but I do feel that Meituan has some level of moat. I wouldn't give it a lot. Some of the key areas that I'm a little bit worried about them is, of course, from regulations, from them needing to please so many parties and their reliance on WeChat. But given that they're already the biggest guys in this field, there are some level of moat that, a new merchant, maybe a new restaurant that comes today, it's very, very hard for them to say, I don't want to be on Meituan platform, right? most likely they will still have to play the game and be part of the network within Meituan. Okay, just a summary for you guys. The key risks that we talk about all this while: the regulation, the Chinese economic risks. These are more short-term because they still rely a lot on Meituan, the Chinese domestic demand. So if the Chinese economy slow down significantly, they would also face some problem. Do take note, they have two classes of shares as well. The shareholder, the founder Wang Xing has a super majority class of share, where at the end of the day it's his company, even though he don't own more than 50%, but he basically control the company for now. And also their money burning new initiative. Okay, so we go one round of understanding the company, understanding and defining what is the key story of this company, where is its moat, and if at this point I'm still optimistic of the company, right? If at this point I'm no longer interested in the company, typically I will not even do this. I will not even look at the valuation, and I'll just give it a go. This is not a company for me. But if at this point, if this company still tick all my boxes and I still find it interesting, maybe I'll run through a valuation on them. It can be a detailed one, like doing a discounted cash flow, but most of the time, I would say it's just a typical scan through is PE, or for this case, maybe even is price to sales. And this is the point where I can share with you what I've done on the valuation. Let me try to get it up. Oops. Sorry, give me a minute because I have accidentally closed that tab. Okay, at this point, while you're waiting for me, if you have any question at all, feel free to type in now and ask while I put it back up. Where is my Zoom? Ta-da! How do I zoom this in? Oh, no. Oh. Zoom, zoom, zoom. Zoom. Hope you can see it. Okay. This is a typical DCF model. This template, you can download it from our website later. Let me just open it up a little bit. Okay, but this is quite a simple one. These are the inputs that you can put in. You can change it, right? When it's your this file is available for you to download. So when you get it, you can actually change this number here. Let me highlight it so you know that you can change it. These are all the parameters that you can change. Okay, before I go into it, this is the point where you have to make a lot of assumption when doing valuation, and which is why I tend not to do a discounted cash flow, because there's just too many assumptions and it looks very complicated and very accurate, but actually it's all assumption. So by changing a little bit of numbers here and there, this valuation figure can shoot up a lot, can be a very, very big difference. Okay, so what I'm assuming here is I'm assuming that at least I'm assuming that their new initiative, their money losing business would break even, right? They are able to find a way to make it break even. So I'm using this number as the operating income of their core business now, the one that's profitable. You will see if you look through their financials, that is not the number, right? Their operating income is not 38 billion. Their operating income is only 8 billion. That's because they're losing a lot of money on the on the new initiative. So I'm assuming they are able to break even from that, or either cut off that part and become a typical profitable tech business, earning around 38 billion of operating income from there. And then I assume that it can grow, continue to grow at about 25% over the next 5 years. Seems a lot, but for the last 5 years, they have been growing at 32%. For the last 10 years, they have been growing 58%. So it's possible and it's quite doable. And after that, I assume that their long-term growth after that would be around 7%. Right? If you count in inflation rate for China, I would say that's still maybe quite possible. Tax rate is 25%. There's no debt, so I put it as 0. Their cost of equity. This is actually a number that I tend to decide myself. So cost of equity, although if you Google it and read through the financial theories, cost of equity has a formula, the CAPEX model, and you can actually find out what is the cost of equity for a particular company or for a particular country. But on my case, as an investor, I generally just use cost of equity as my required return. So I want a stock that has give me 12% a year. So I put 12%. If I feel this company is relatively quite stable, maybe say, for example, if I look at Microsoft, maybe I say, okay, I just need the cost of capital to be 8%. But from Meituan, maybe I want a higher return from it. It's a much riskier stock. So I set it as 12% as my requirement return. So meaning that if at the end of the day, the valuation that I come up with is exactly the same as its current price, it means that from my assumption, I can expect that this stock will continue to grow 12% a year for me, even if my valuation matches directly with the market cap that it is now. So that's what I meant when I say my expected return is cost of equity. The rest is setting up the reinvestment rate, basically. So you can play with these numbers to set the reinvestment rate. I set it so that in the first 5 years, we don't see any cash flow. They will just reinvest back the money, and then later on they will have around a 50% reinvestment rate on the company, while adding on more cash in the future. So just running through all this, you can see I make a lot of assumption, and I come up with a valuation here. The value of equity is in renminbi, right? All their data is from renminbi, so I switch it to Hong Kong dollars. And it give me that this company, based on my assumption, is worth roughly 600 billion Hong Kong dollars. 600 billion Hong Kong dollars. So what I do is I match it with this market cap number here. You can see that it's 616, meaning that whatever assumption that I assume very much aligned with what the market is feeling that this company is worth as well. So in theory, if in the perfect world, if I buy it now and my assumption turns out to be right, basically I can expect a 12% return from Meituan here on out. But of course, that's not going to be the case, because the valuation comes from my own expectation and my own assumption. So therein lies the risk of investing. That's why people say investing is risky. This is the part. This is the unknown part for investing, and which is why a key reason why I always advocate that we have a diversified portfolio, because we never know on which assumption we are right, which assumption we are wrong. But if we have a sound process in totality as a basket, typically we will do okay. Okay, so all this, you can download it later. And let me jump back to the presentation. Do you guys have any question? Do put down the chat box. I don't know if I on the chat box for you guys. You guys should be okay to chat. Try it out. If you're on your phone, it should be at the bottom. There should be a chat button, or there's a three dot. You can click on the three dot and you can find the chat box as well. If you're using your PC or your laptop, just go to the just go to the control panel. There should be a box for chat as well, and you can talk to me then. If not, let me share back the presentation. Ta-da! Okay, so there we have it. Oh, yeah, before that, actually, I should share one more thing with you guys. Which is here, okay? And if you're not doing a DCF analysis or valuation, sometimes I just check through, either through my iFast account or through my Morningstar on the valuation over his history. So you can either look at if they has PE, how's the PE looking. For this case, because there's not much E for its history, maybe we can look at the price to sales. And you can see in the past, it's been trading at around 4, 6, or even 16 times at its peak on the sales. But now they are trading around 2 times their sales. So at least according to its history, it's trading at pretty low valuation. But again, doesn't mean that it will go back to that number lah. Just compare it with its history. It looks reasonable now, or even attractive now. Okay, and that's basically my process. And then you have to decide whether this company is really for you, or it should be existing inside your portfolio. It might be for you if, say, you are someone that is still optimistic about China, optimistic about the demand in China, optimistic about the growth of internal consumption. You believe that it could rebound and it could fight back and it will not fall into what happened to Japan, a lost decade, right? They can turn around what's happening to them now. But again, it might not be for you if you're someone that prefer something more stable, more stability, and the way that Wang Xing like to burn money and gain market share, very aggressive. Maybe you're not that comfortable with it, or you're not comfortable with China itself. That's fine. You can skip such a company. So the key for us to build when we're building a portfolio is to select stock that give us a peace of mind. It can be a wildly volatile stocks and something that is very risky, but if it's something that you're still comfortable in owning it, or you know how to size it to a point where it's okay if it fails, then there's no such thing as the right stock to own or wrong stock to own. The more important thing is actually our entire philosophy and our process, I would say, when it comes to investing, is much more important than actually the stock that we buy. In fact, all of us today can buy all the same stocks, right? If we do an experiment today, all of us buy all the same stocks today, all 10, we choose 10 stocks, and then we say to each other, let's buy all these 10 stocks, equals weightage across on a portfolio that we have. And 10 years later, I am very, very sure all of us will have different return, will have different performance in our portfolio. Even if we start out with the same stock, even if we share the same thesis of why we buy this 10 stock. And it really comes down to having the right mindset and concept and philosophy of investing that truly give us the long-term edge in the long run. Okay, so I hope that's something that we can all think about. The next section that I always end on my webinar is a little bit spin-off. It doesn't have to be talking about investing all the time, I feel. And I just want to share, things that has come across my time these few weeks. And I came across just an audiobook on The Little Prince. It's actually a book that I deeply love, and one of my favorite books of all time. I read this book quite a few years ago when my kids are very, very young. I was actually thinking that I'm reading, a children's storybook to them. They didn't quite get the book, but but the book ended up speaking very, very, very profoundly for me. And Little Prince is actually very philosophical, in my opinion, and it teaches a lot of good values. And I think it is until now still a book that I sometimes just pick up and read a few chapters to remind myself, on some of the key things, key takeaway that it talks about. And I encourage, if you have not read it, right? I encourage, there's free audiobooks on YouTube. There are free audiobooks on Spotify. And of course, I will encourage you to even get the book as well. It is in my bookshelf, a must-have book on my bookshelf. Just a very candid and very innocent way of looking at life, and truly understanding what is, when we talk about a beautiful life, what really is a beautiful life, and what are some of the most important things that we often take for granted, and some of the most important things that we really truly value are actually invisible. And because it's invisible, we tend to forget sometimes. Yeah, so that's it. And we can go to some questions first, and then I'll end with the last section that I have for you guys. Grace. Hello, Grace. Long time no see. I'll read out your question if the rest of us is not able to see the chat box. So Grace is saying that I don't see Meituan having a strong moat. They go into delivery, hotels. As a customer, what is the pressing reason for me to use Meituan other than other delivery services? Are there any competitors also in the delivery space? Yeah, so the delivery space is actually quite consolidated now, mainly by two companies, Meituan and Ele.me. Ele.me is a subsidiary of Alibaba, and Meituan is at least double the size of Ele.me, and together they have a market share of more than 70% of the delivery market. So this space is generally quite it will always consolidate. Just think of our area, right? Our side is also consolidated, mainly Grab, Foodpanda. That's it. And then you could argue that it might even be consolidated even further into just one guy. That's possible. So it's a market where scale wins. So in China, it's already more or less break down into either Meituan or Ele.me. And in fact, my trip to China, I would say that I see much more Meituan riders compared to Ele.me riders, and that's kind of show us that they have at least this army of riders around. And when you have this army of riders, you are the service that provide the quickest delivery and most reliable service, and that end up becoming a moat. Not that big a moat, I agree with you, but still a little bit of moat. Thank you, Grace. Nice to hear from you again. If you guys have any question, remember to type on the chat box, but we can also get back to at the beginning what we talked about, and I want to continue that and end with this, which is a key part of what I realized in building long-term wealth, something that will hinder us from reaching our goal just a little bit faster, is all these fees, especially the annual fees that the funds are charging us, and where we could find ways to find a cheaper alternative but equally effective funds out there to replace what we have, which is why I'm sure you guys already know that I have joined iFast as a financial advisor, and I'm really trying to do something different compared to what the industry has always been doing. And I'm very, very fortunate that the team and the bosses in iFast are also supportive of how I want to do it, and which is basically I want to create a system, or at least I want to be of service that is truly beneficial for you and for my clients, which is that instead of just pushing funds that would maximize, say, my commission, I rather help people maximize or improve the efficiency that they have in planning out how to create a portfolio that will most resemble this blue line, right? Where are the key areas that we can cut costs on, but still not damage the possible return in the most safest manner, and plot something that is much more closer to this blue line compared to what the industry is offering right now on either the orange line or the yellow line. Somewhere in between, I think it's very, very doable. I have done it for myself, and I'm very, very excited to hopefully work with you guys to do that as well. And I come up with a solution system that basically, instead of just pushing, the hottest fund of the hottest fund right now for everyone, maybe now it's AI or whatever, but rather have a chat with you guys on reviewing your current portfolio situation, your long-term goals, and understand where is it that you want to be at which point in time, and from there we work back and improve and try and maximize. What are your portfolio right now? How can we maximize it? Maximize the return to match your objective, but also minimize the fees and minimize the risks that you're taking on your portfolio, and creating an automated system for you. And then from there, my job would always be there to help you monitor that portfolio, and also through Premium Club provide some education as well for you and your family as well, right? So if you or your friends would be interested to chat with me to find out a little bit more on how I can help you replan or just at least review your current investing journey and your investing portfolio, and how I might be able to maybe seek out much more efficient and cost-effective way for you to construct your portfolio, you can either just drop me a WhatsApp and we can set up a call, or you can even just email me. This will be my iFast email address, and directly I love to chat with you guys, be it if you are from Singapore or from Malaysia, that's fine. I'm more than happy to just have a chat. As you guys know, iFast is a Singapore listed company, and so they have offices and they have solution for both Singapore clients and also Malaysian clients. All right. So thank you so much for all of you guys joining me today. And I always like to end my presentation with a little bit of quote that I find that is interesting for you guys. And today, remember a little bit from The Little Prince that all grown up were once children, but only a few of them remembers it. And sometimes we need a little bit of our childhood innocence to come back in our life to make life worthwhile, right? Thank you so much, and I hope you guys have enjoyed this webinar. As always, if you're a member, you can log on to the members page and you can see the entire replay, this slide deck, and also the valuation Excel would be uploaded onto the website by tomorrow, and you can download it and view it at your own pace. Thank you so much, and I hope you enjoy it. Till we meet again in the next 2 weeks, invest safely, guys.